The latest monthly inflation data released yesterday shows cost of living rose by 0.5% in April. That's up to 6.8%. The increase was unexpected and it could mean another rate hike for the RBA. For more on this, let's bring in Shane Oliver, Chief Economist with AMP. Thanks very much for your time. I guess, first of all, higher than expected. Caveats on that, it's monthly. It is a bit less reliable compared to the quarterly figures. And if you strip out some of the volatility, it is actually ticking down. That's around holidays and food and so on. So what's your take on how much this monthly figure means?
Look, I think we have to treat it with some caution. On its own, it's probably not enough to trigger a hike by the Reserve Bank. For the reasons you mentioned there, it is a relatively new indicator as well, so we don't know how reliable it is. And as you said, that bounce was due to a bunch of things which may be temporary. For example, the rise in holiday travel costs in April may have been due to the Easter holidays at the time and school holidays at the same time. So it's dangerous to read too much into it. But by the same token, it was expected to fall further. To get the Reserve Bank's forecast for the quarter as a whole of 6.3%, you do need to get some low numbers for the next few months. And I think its release at a time when, or the day before, or we've got tomorrow, the national wage case decision for the minimum wage coming out. If we just had the inflation numbers on their own, I don't think they'd be enough to trigger the RBA. But when you put that together with the wages situation, which is still looking to be somewhat high risk in terms of a further upside increase there, that could trigger the Reserve Bank to raise rates. So I think right now, many analysts will be looking at those minimum wage numbers when they come out tomorrow. Obviously, if we see a further significant pickup from what we saw a year ago, that will add directly to wages growth. It will also act as an influencing factor, pushing up wages in other sectors in the economy. And that's at a time when public service wage caps have been removed in New South Wales, relaxed in Victoria. We're looking like a fairly solid increase in wages for public sector workers federally. And of course, the aged care 15% wage rise as well. So all of those things are weighing at a time when we don't have a lot of productivity growth. And that's why I think these risks around interest rates are now very high.
That was alluded to by Phil Lowe around lack of productivity. And as you said just there, we have locked in wage increases out there. This one tomorrow, when you say it will be looked at closely. So the unions say 3.8. They say 7. Business groups essentially saying about 3.8. Where does it need to be for the RBA to say, okay, now's when we need to hit the button? Is it sort of 5 and above? Is it 5.5? Where do you see it as what the RBA will consider that a danger?
Well, last year it was 5.2 for the minimum wage and 4.6% for award wages. So call that an average of 5%. If you sort of look at it that way, if it comes in around that 5% level, then I wouldn't be too concerned. It's consistent with what we saw last year. It wouldn't imply any more upwards pressure to what we've seen over the last 12 months. But if it comes into, say, 6% or 7%, then I think the RBA will start to get concerned, particularly if it's at the high end. If it is at 7%, if it does compensate for the inflation over the last year, and I can understand why workers want that to happen. The problem is that it would be seen to be locking in higher inflation expectations, and that's what the Reserve Bank would want to guard against. If people hear that there's been a 7% increase in the minimum wage, then they would maybe start to demand the same thing as well. So that's the problem here. 5%, bottom line is 5% would be okay. 6%, gets a bit iffy, but if you're up around 7, then I think it's definitely a concern for the RBA, and it's quite likely they would then go next week with another rate hike.
Does the Commission have a bit of cover on this, in particular around the minimum wage element? Because the budget, the cost of living help, was really focused on the lowest income houses. So whilst you'd go, well, look, these households are doing it tough, and these budgets and these households have the least room to move. Is there cover from the Fair Work Commission, do you think? And would that lead you to think it's probably closer to 5 will be the decision?
Yeah, there is that argument that there was help in the budget for low-income earners, and maybe this was part of the Treasurer's strategy, although he didn't say as much, that it does take some pressure off the Commission in that sense. So they may come up with a number which is closer to 5, and obviously for award wages might be a little bit less than that. So hopefully that's what we get here. It's just that it is coming at a time where the Reserve Bank has indicated a lot of concern about wages growth and the lack of productivity. And, you know, the problem for the economy as a whole is that we are seeing increasing stress for those with a mortgage. The Reserve Bank governor, I think yesterday, repeated that something like 15% of variable rate borrowers could be in negative cash flow by the end of this year.
Just finally and quickly, Shane, if we see another rate rise, where do you see the chances, or what are the chances of a recession then?
Well, to be honest with you, that would take us above 4% for the cash rate. It would take mortgage interest payments and so on, mortgage payments generally, to record levels. And I'd have to say the odds of recession then would be 50-50. It's, yeah, we'd be, I'd have to seriously think about starting to forecast a recession if we get to that level. At the moment, I think it's a close call, but if you get above 4%, then yes, I would be very worried about a recession.
So one more rate hike for you could tip the scales towards, you would consider forecasting, on balance, I understand nothing's certain, but on balance, a recession.
Yeah. That's right.
Okay.
I think it's finally balanced here. Things might look okay now out there, although there are increasing signs of stress, but we know from the late 80s, early 90s that these things take a while to show up. And, you know, I do worry that we're going too far here with the rate hikes.
Okay. All right. Interesting to get your thoughts. A lot of people still on those fixed loans and coming off them. So, yeah, some shocks coming for households. Shane Oliver, thanks very much.